Good afternoon, viewers and listeners, and welcome to another session of a FinMeUp conversation. I'm joined in studio with by Dewald Peterser from WTS Renmere. Got the name right this time, which is a good start. And today we're going to be talking about tax, mostly individual tax, as we head to the end of um, the tax season, or the end of the tax year, end of Feb for most individuals. We're going to get some insights from Dewald on the do's and don'ts, and just talk about tax in general, and hopefully you get some insights and tips to take away ahead of filing, which will mostly be July, whenever that opens. And David will give us that information. So, David, if you don't mind just starting, introduce yourself, give us some background to yourself and the company, and then we'll get into some questions.
Perfect. So as Travis mentioned, I work at WTS Renmere. We're a transaction and tax advisory firm, and have a master's degree in tax law.
Oh, good, so with the right person, yeah. Cool, thanks, David. So maybe just give us some insight. So, taxes. I think it overwhelms a lot of individuals, but I don't, no one, or I think the large proportion of South Africans don't have access to accountants, bookkeepers, anyone to assist them with filing, and they just sort of solely rely on what's available through e-filing or, um, you know, if they can. So maybe give us a bit of your opinion on why individuals feel so overwhelmed. I don't know if you've seen it in terms of individuals you guys deal with, small companies as well. Give us some info on why. I mean, if for me, it haunts me every year as well. This, have you done everything correctly? It's almost like Big Brother is just always watching it. SARS, I think, is probably the most efficient government sector in the or institution. So yeah, give us some this is an opinion on that.
So I think the first thing to acknowledge is that this is a commonplace psychological phenomenon. There's even a name for it. It's phorosophobia, from the Greek phoros, which means tax.
Okay.
So most people feel like that. And if you think about it, anxiety is something that people experience in relation to future uncertainty.
Fear of the unknown.
Exactly. And most people are just unsure about their tax position. So it follows logically that they would be anxious about their taxes. And then typically this drives avoidance behaviors, which end up making the problem worse.
Okay. That makes a lot of sense. And then leading on to that, I mean, what then are some of the common mistakes you see? Um, I know, just for more context, I suppose you are more on the sort of commercial side or the corporate tax side. But any mistakes, common mistakes that people that you guys see that our viewers and listeners can avoid making.
So I think the first thing to say is that lots of people are unsure whether they are provisional taxpayers or not. So if you're a salaried employee and you don't really have passive income, let's say passive income of less than 30,000 Rand a year, then you're probably non-provisional, which means you only do your ITR 12 tax return once a year.
Okay.
But if you have income from some side hustle, any business income, or you have passive income which exceeds 30,000 a year, then you are probably a provisional taxpayer. Now, that means you still need to file your ITR 12 once a year, but in addition, you need to file what's called an IPR 6,
Okay.
which is your provisional tax returns 6 months into the tax year, which would be end of August, and at the end of the tax year, which would be end of February. So how provisional taxes work, it's not a separate tax. It's a prepayment of your income tax, much like pay as you earn, which normal employees get deducted each month. It's the same concept, except here you are responsible and not your employer.
Yeah.
So that's one mistake people often make, especially if they start to earn income from some side hustle, or they rent out a room on Airbnb and the like. And with that, you because they don't then comply with the filing and the payment obligations, penalties, and interest follow.
Yeah.
So that's one thing. Another one would be people, to be frank, taking chances.
Yeah.
I'm
I think
all
there's a lot of that.
I'm all for. Listen, each taxpayer is by rights. They should claim every refund and be as efficient as possible.
Yeah.
That is within their rights. But to to push the boundary to claim refunds which are not properly due to them, that's tax evasion. That's a crime.
Tax fraud, yeah.
And at the end of the day, it's not worth it.
Yeah.
Those marginal gains is not worth a criminal investigation.
Mm.
And so that's definitely something which people should really be careful of for. And I think we'll speak about it a bit later as well. But SARS is gearing up.
Mm.
They have profoundly powerful AI tools, and I think people should operate on the presumption that SARS can see everything. So taking chances is another big mistake. And recently,
Can I just stop you
yes,
just
yes.
before that, just to ask in terms of where can someone check what they're registered for, if they're appropriately registered for PAYE or as a provisional taxpayer, in case, I mean, I know you've given the kind of the triggers for each of those, but if someone is now earning, obviously, from a side hustle, they've reached over the threshold and they should be paying provisional tax, how does one go about that?
Yeah, so firstly, SARS's e-filing platform would be the platform on which you access your own profile. Now, you can also grant access to tax practitioners or any registered tax practitioner, which could include chartered accountants, etc. Anyone that's registered
Yeah.
at SARS. But then there's also what's called the SARS online query system,
Okay.
which you can just Google, and there's lots of options for things you can check, things you can register for, and there you can see, are you registered for tax, etc.
Okay, cool. Thanks. Then you were going to get on to a second common mistake.
Yeah, what recently SARS has been rolling out once again, probably due to the increased technological sophistication, what they call an auto assessment.
Mm.
And it's very convenient to taxpayers because you just receive this auto assessment. They've already populated the return because they have access to data from your employer, from banks and financial institutions, etc. But what people should be careful of is just blindly accepting the auto assessment. You have to check carefully that it's correct, because if it's not, say you have a room you rent out on Airbnb, SARS won't necessarily know about that income, but then you just accept the auto assessment. And what you don't realize is that that's not a cover against them imposing penalties and interest
Yes.
when they actually figure out that it wasn't correct.
Mm. Yeah, I was going to ask how accurate it is, but I suppose, like you say, it depends on what information and data they've got access to through whichever institution it is, whether it be an employer, bank, like you say. And the liability still sits with the consumer to go and ensure that any additional income is obviously declared and taken as part of that calculation to ensure an accurate return is filed.
Yes, and the Tax Administration Act is clear that the burden is on the taxpayer to prove the tax position taken.
Yeah.
So although it's administratively convenient that SARS does the auto assessment, you have to make sure that it's accurate.
Yeah. I mean, it's a sort of a real use case. I had a family member who had been retrenched, and they'd started withdrawing on their pension from a living annuity. It was put into that vehicle, and then they started working again. Got for whatever reason got a good deal and started working. PAYE was being paid by the employer, and the tax was being deducted from the fund and paid across to SARS as well. However, the tax on there was a sort of an increase in the tax bracket. So more tax was payable, but because I don't know exactly, maybe you can give us some context, because I think it might happen more often than in those that have hit retirement age but then still working and withdrawing from both salary and from an annuity. The correct tax wasn't being deducted on the annuity, and it then led to an audit, and it then led to
Mm.
tax penalty and repayment of whatever the lost tax or the obligated the tax amount should have been paid for those 2-3 years. So I mean, how, yeah, in that case, because I mean, he just wasn't aware, no clue. You just assumed that the correct tax would be deducted on sort of both sides. Um,
Yeah, and
yeah,
b- the once you've retired and you start drawing from, say, your pension savings or your retirement annuity, that gets taxed according to a different rates table than your normal marginal rates.
yeah,
But then if you're earning income monthly, that would still be at your marginal rates.
hmm,
And so this is typically the kind of situation where I would say, if you are in a strange kind of situation like that, it's always worth it to just check with a financial advisor or do some research,
mm,
because at the end of the day, the tax bill or the penalties and interest is going to be more than just quickly checking in.
yeah,
And that actually goes back to your previous question, because that's also a mistake people make, is not reaching out for advice in
yeah.
time.
I think the argument though is, I mean, he never knew.
Mm.
And for the average consumer that doesn't have exposure to tax, has been employed their entire life, for example, they've just gone by the book. HR has deducted X and paid X across, each month, each year, and then this is now sort of a dual income. But you just expect that the financial institution that you sort of paying your annuity from your fund is correct, calculating the tax correctly. Now, understand, obviously, it's neither's kind of fault because they don't know about each other. But the consumer, I mean, if they don't know, now they get penalized. I understand that tax is due, right? I mean, I don't know the sort of full details in terms of how that was treated, but in your opinion, I mean, is there any kind of discretion that's applied to SARS to say, I know the liability is on the consumer, but in terms of it's a mistake, easily made mistake because consumers not in finance or exposed to tax planning or anything like that. Um, are they lenient at all given a certain scenario?
The short answer is no.
Okay.
But so sometimes it happens that you realize that you've been doing something wrong in relation to your taxes. Then there is what's called the voluntary disclosure program,
Hmm.
where you can approach SARS on this basis and enter into a voluntary disclosure agreement with them. And then you can fix your tax position
Hmm.
without the penalties
Okay.
uh, being incurred. So, but
This
sometimes,
this is any scenario. I mean, just going back to some of the common mistakes that are made. I mean, this is an unknown one, but those that have, they're fine. They've been earning, money on the side and they haven't declared it. They can also go part of the voluntary disclosure and then rectify their mistakes without penalties.
yes, because the rationale is that SARS has this program because they want to foster a culture of voluntary compliance. But the fact of the matter is that sometimes they pick up something and you never knew,
Mm,
and then it's a verification or an audit, and then it's no longer regarded as voluntary
mm,
because you didn't come forward with the information.
yeah. Okay, that makes sense. Just asking the question to see if there is any
Mm.
lenience, if or they just throw the book at it and then that will obviously make you pay your dues. Right. So, I mean, we've spoken a lot about the mistakes and gone down a bit of a rabbit hole, sort of dark side of tax and what actually scares everyone. But let's go on to some of the tools, the deductions. I'll start in terms of in our world at FinMeUp, we do retirement planning and we use retirement as obviously a tax planning mechanism as well, using the deduction afforded to individuals to deduct off their tax payable. So, in terms of additional tools to that, what is give us a hypothetical scenario of what an efficient tax structure for an individual would look like.
Yeah, so let's ignore deductions in the sense of business related
Sure.
deductions. Even, though some people can run a business in their own name as
Mm,
a sole proprietor. The thing, I think, especially with this so called refund driven mindset, It's almost as if people are missing the forest for the trees. And while going after a refund, again, if you do a refund, go after it.
Sorry, missing the forest for the trees. Give us a breakdown there. It's thrown me completely.
To put it differently, it's as if two hyenas are fighting for scraps, and then the third hyena runs away with the kill.
Got it.
The refund is the scraps.
Okay.
The kill is what you've alluded to, which is tax planning. Because what people have to realize is that tax is the single biggest expense you will ever have by far, which means that every tax decision is an investment decision, and which also means that tax is the one thing you should try and optimize.
Yes.
So
I've never heard it put like that before, and that is quite scary to think about it like that. But
there are philosophers who say that taxation is the state. A tax is a very large part of your life, even though you try and ignore it. So for the typical individual, my two most important things would be to say, do you have a tax-free savings account? And are you contributing to a retirement annuity or the like? And let's start with a tax-free savings account. Let's say you're a young professional or a young salaried employee. The tax-free savings account, you get 36,000 Rand a year that you are allowed to contribute, and a lifetime limit of 500,000.
Yep.
Which means more or less it's going to take you 14 years to fill up that bucket. What then happens is all throughout this process, the investment accumulates and grows tax-free. And at the end, whenever you withdraw money from it, it's also tax-free. What is in some cases useful is that the money isn't fixed like retirement money. You can withdraw from it. But if you withdraw, that doesn't decrease the amount you've contributed. So once you've contributed, say, 500,000 and you withdraw 100, you can't put anything back.
Yeah.
So ideally, you would never touch the money unless it's an emergency. Now, yes?
No, sorry, carry on.
So
I'll jump ahead of you there for a second.
So especially for young people, I think it's advisable to try and fill this up as quickly as possible, because you then can leave it and it can compound over your entire career. And one day in retirement, you can start withdrawing from this, and it would have been accumulating for years and years, and you never pay tax on it again.
So I've got a theory and a plan. It's not mine, so for full disclosure, it isn't my plan. I did hear it when tax-free savings accounts came out all those years ago, and the logic was that using your RA contribution, whatever the refund amount or deduction amount you get on a monthly basis, if it's done upfront or return time, using that, and depending on what the value is, maybe you have to supplement it to hit the max per annum, using that to put into a tax-free savings account, building up, as you say, hitting retirement, and then as a supplement, you've never, you're getting that money tax-free. You've never paid tax on that money at all. Does that sound logic?
Yeah.
Okay. So as a tool that I've been using, it's now vetted by Dewald.
and why I say for young people specifically is, and in an ideal situation.
Wait. What is your idea of young?
Let's say, for purposes of this example, anything under 40. But the point is, the point is that the value in the tax-free savings account lies particularly in the fact that it can accumulate and you can withdraw money tax-free. So the longer you leave it, the more beneficial it becomes. And that's why I focus on young people. But in an ideal situation, everyone would contribute to the full extent to their tax-free savings account and their retirement annuity. Now, the retirement annuity works slightly differently in that you get the amount that you contribute as a deduction, which means that, say, you earn a salary per annum of 500,000 and you contribute 100,000 to your retirement annuity, then you would be taxed as if you earned 400,000. And then that investment also accumulates and grows tax-free. The difference now is that once you withdraw, after retirement, it is taxed, but at the lower marginal rate.
Yeah.
So at the retirement rates. So the value in the retirement annuity lies in the arbitrage, the deferment of tax to later and at lower rates. And that's especially useful if you are earning at the higher brackets, which young people typically are not. So the relative saving for a young person is less than for someone that's more advanced in their career, because the young person would typically be at a lower bracket.
Sure. So then, if I'm understanding, the combination of both as a tax efficient technique or plan is what I mentioned in terms of utilizing your sort of tax-free portion of your money deduction, whatever you want to label it, on your contribution to an RA to fund tax-free savings. So utilizing the deference of tax to a lower tax bracket at retirement on the RA, plus you're then supplementing with tax-free,
Exactly.
100% tax-free money um, within the fund, and when you withdraw it then outside of the tax-free savings vehicle.
Yeah, so that would be the forest, the large gain you get eventually, as opposed to an annual refund, which is a tree.
Yeah, cool. That's really great advice. So that's your ideal, is utilizing those two investment vehicles for tax efficiencies. Is there anything else? I mean, as a standard employed individual, like you say, there's various deductions afforded to those that are sole props, or those that are contractors that not necessarily sole props but incur expenses in the production of their income for the companies. Anything for this the stock standard employed individual?
Well, there are certain provisions, for example, work from home, home office kind of deductions, but that's another thing that people take liberties with, and the rules are quite strict. So for stock standard employees, there's not much relative to the gain of that kind of retirement planning we've been talking about. There's not that much. But if you do have a side hustle, or you earn business income, let's say you have a small business, less than R1 million a year, I would encourage everyone to go and find out whether you qualify to register for turnover tax on that business income. Because how turnover taxes work is that instead of the income from that business being uh, aggregated with your other normal income, it's dealt with separately, and it's taxed at the turnover instead of your profit.
Yes.
But it's taxed at a very low rate. So it has a separate rate table. The maximum is 3%.
Okay.
So, and because you have to be earning less than R1 million a year, you're gonna end up, even if you earn almost R1 million, with about 15,000 rands tax a year, which is much lower than you would have paid on that side hustle income if you did not register for turnover tax. So I would definitely encourage people to explore that option if they have a side hustle.
And if it's your sole income, but it's less than R1 million, but it's on a contract I use, for example, can you register for turnover tax as well if it's your sole income?
That would depend on what exactly you're engaged with. So typically, the kind of services that you would be offering under an employment contract, like consulting and the like, they would be excluded in certain instances. So that's why I say you need to go and check. And also, I should just add that the turnover tax is premised on a small business. So typically, passive income would automatically be lumped together with your other normal income. So you shouldn't try and structure such that your passive income falls under the turnover tax. That's not how it works.
Sure. Because, Dewald, thanks. Looking more into the future, what what do you feel, what do you know is on the cards? What's changing that impacts South African taxpayers?
So the first thing would be to reiterate, as we've mentioned earlier, that SARS is spending billions of rands to upgrade their systems. They use very sophisticated artificial intelligence and machine learning technologies. So they are certainly ramping up their ability to detect non-compliance. But at the same time, they are trying to foster a situation where tax just happens. So, in other words, they are trying to make it easier for law-abiding citizens to have an easy time of it complying with their obligations, but at the same time, they are cracking down more and more on the non-compliant.
Okay.
So that's an important thing to realize about the overall context. And then, broadly speaking, the data appears to indicate that more and more people are engaging with financial advisors, but that financial literacy per se is not necessarily increasing. And I think people are getting more engaged with their finances, but often, ironically, that makes them feel even more overwhelmed, especially when they get information from various disaggregated sources, so-called finfluencers that might be leading them astray.
Yeah.
And in that respect, it's always a good idea to have one person you can go to who you can trust and you can ask questions. And that's, I think, an important point I also want to make, and it goes back to what we said right at the beginning as to uncertainty. The thing is, you only have to figure out the 20% of things you need to know to make 80% of the difference in terms of your tax planning. You only have to figure it out once, then you know it. And so it's just the most obvious thing that the sooner you do it in your life,
Yeah.
the more you stand to gain from it. So I would say that you should really try and make a point of figuring out this year, how does this work?
Yeah.
Because you will stand to gain from that forever.
Yeah. Yeah, and I think to your point, it's, or the comment made earlier, then to your point is, the overwhelming nature of tax and the avoidance of confronting tax and just kind of hoping it sorts itself out kind of mentality, to actually taking it sort of head on and learning, and then also in doing so, you understand your situation and how you can plan better as well. And I mean, also just getting in touch, with a tax planner, financial planner like ourselves, and actually sit down and work through it, because you generally would need it once, and maybe you need some advice when it changes. If anything changes from your position on tax, then the advice is there. Otherwise, it's kind of a once off. You plan it and then you move forward. Um, Good. Dewald, we've run out of time, so thank you very much for joining us on FinMeUp Conversations. Do you want to give one last comment to our viewers and listeners?
Yeah. So we can speak about SARS leveling up, but I think the technologies are available for taxpayers themselves to level up.
Yeah.
And yeah, just to reiterate, this uncertainty that drives the avoidance behaviors, it's a portal into chaos, as it were, and there's nothing as satisfying as facing that voluntarily and closing down the portal and having comfort about your tax position. So I would encourage everyone to make this the year that they finally fight that dragon.
Yeah. Great. Thanks, Dewald.